Hi, everyone. Welcome. Thank you so much for joining us this morning. My name is Andy Murray. I'm the Associate Dean of Enrollment and Marketing for the Fordham University Real Estate Institute. We are joined today by some wonderful people, and I just want to go through a little housekeeping while everyone is still coming in through the waiting room. We are recording this chat today. So if you would like a digital transcript of the event, please email us at realestate@fordham.edu. If you notice that your mute is not on, please mute your microphone. You should be muted on entry, but if you're not, please tap that. We will have a Q&A at the end of the event. So if you have any questions as we go along, feel free to type in your questions and they will be moderated and discussed at the end. And now that I hope everyone is in, I just wanted to thank our organizing group this morning. We are joined by Neil Madsen, who's the principal of Madsen Advisors. He's also the chair of the Metropolitan chapter of the Counselors of Real Estate, and he's a member of our executive advisory committee at the Fordham Real Estate Institute. He was part of our planning committee, as what I'd also like to thank Patrice Darrington from Columbia University. She's the director of the Real Estate Development Program, GSAAP, at Columbia. I will introduce Neil, and he will introduce our fireside chat participants. Thank you again. Neil, I'll pass it to you.
Thank you, Andy. Good morning. It's my pleasure to welcome everybody. And this is the first installment of what has become an annual event co-hosted by the Counselors of Real Estate, Fordham University, and Columbia University. So in a normal year, 150 or so of us would be meeting in person this morning to discuss some of the most important issues affecting the real estate industry. For obvious reasons, we're doing it virtually this year, and we've decided to break it up into a series of events. For those of you who might not know us, the Counselors of Real Estate is an international organization of real estate professionals who provide intelligent, unbiased real estate advice that achieves the best results for our clients or employers. As the most respected real estate specialists in the industry, counselors work on the most complex and important projects and are known for innovation and creative problem solving. So if that sounds like the kind of advice you need or the kind of organization you'd like to be part of, feel free to contact me and I'll put you in touch with the right people. Speaking of complex and important projects in need of innovation and problem solving, the world has some big ones right now. And the purpose of this event, something old, something new, something borrowed, something blue, is to address some of them from the vantage point of real estate's public debt markets. With that, it's my pleasure to introduce today's speaker. Hugh F. Kelly serves as special advisor to Fordham University, where he helped design and launch the university's Master of Science in Real Estate graduate program. For more than 30 years, he taught at New York University, where I might add, he was my econ teacher 30 years ago. For nearly 20 years, Mr. Kelly has headed his own consulting practice, Hugh F. Kelly Real Estate Economics, serving national and international real estate investment and services firms, governmental agencies, law firms, and not-for-profit organizations. Previously, he was chief economist for Landauer Associates, where he worked for 22 years. Mr. Kelly is a member of the Counselors of Real Estate and served as its elected chair of the board in 2014. He earned his BA from Cathedral College in New York and his PhD at the University of Ulster in Belfast, Northern Ireland. His book, 24-Hour Cities, Real Investment Performance, Not Just Promises, won the Gold Award as Best Book from the National Association of Real Estate in 2017. Lee Overby is a managing director and head of CMBS research within structured product research at Wells Fargo Securities. She leads a team covering agency and not agency CMBS, as well as commercial real estate CLOs. Throughout her 20-year career, Ms. Overby has focused on various aspects of the CMBS market, including senior roles on the sell side, the buy side, and at a rating agency. Prior to joining Wells Fargo in 2018, she oversaw CMBS analytics and research at Morningstar Credit Ratings. She headed CMBS research at Nomura Securities, where she also covered consumer ABS research. She was a credit analyst within the CMBS investment group at BNY Mellon and was a member of the CMBS strategy team at Bank of America Securities. Ms. Overby holds a bachelor's degree in mathematics from the University of North Carolina at Chapel Hill and a master's degree in mathematics from Vanderbilt University and has completed doctoral research in mathematics. As always, and as Andy said, feel free to send in your questions. We'll be monitoring them and revisiting them at the end. And meanwhile, over to you, Hugh and Lee.
Well, thank you, Neil, and welcome to everybody. Thank you for getting up bright and early on this Wednesday morning. Very bright and early if you happen to be the time zone west of the Eastern time zone. We have a very important subject to deal with today, and that is CMBS, which falls under the overall heading of commercial real estate debt. Real estate is still leveraged at about a 3-to-1 level of debt to equity, and CMBS is an important element of that, and has been now for about the last quarter century. It's important because it's public, which also means that it's monitorable and gives us very timely information, not necessarily available from the originating debt markets. And it's also sensitive in the sense that it is traded daily, minute to minute, and so gives us a real sense of the short-term changes in the market. So our topic today, something old, something new, something borrowed, something blue, relates to something old, legacy CMBS, something new, new issuance, something borrowed, the standards of underwriting, and something blue, red-blue, I guess, the influence of the fiscal and monetary policy decisions that are made at federal level that affect all of us. So with that, I'm going to ask Lee to take over. And Lee, could you talk for us a little bit about what's going on with legacy issuance? What has been the performance in this pandemic era of CMBS that was issued prior to the pandemic, and what's happening in those current markets?
Sure, Hugh. Thank you very much for the warm welcome. So it's funny, when we started talking about how to prepare for this call, you used the term legacy to refer to bonds that were issued prior to the COVID crisis. This harks back to an earlier point in my career when legacy referred to bonds that were issued prior to the great financial crisis. And so it is somewhat of a coming full circle with looking at how commercial real estate and CMBS does perform under various crises. It's interesting. The great financial crisis was truly impactful in a couple of ways. Certainly the downturn was significant, but on top of that, the deals, the loans that had been underwritten right prior to the financial crisis were way over levered. I mean, I don't think there's much argument about the fact that there was simply way more leverage in the system than we needed prior to the great financial crisis. And that combination of really over levered loans with a really deep downturn negatively impacted the CMBS market by quite a bit. This time around is a little bit different because coming into this crisis, leverage was solid, but not awful. LTV on a lot of the loans that were originated in 2019 was hitting around 60%. Debt service coverage ratios were more than 2 times. And so that gives borrowers a good amount of cushion coming into this current crisis. The question for all of us is, of course, whether or not that cushion will end up being sufficient to help these companies, these borrowers weather this COVID crisis. So we have some slides. I promise I won't bore everybody with billions and billions of slides, but sometimes a picture does say 1,000 words. So here's something that we put together to kind of illustrate this fact. This slide here on the bottom left, this one shows just straight delinquencies. delinquencies and special servicing percentages for conduit CMBS. Within CMBS, conduit is really the benchmark. That's the one that we go to get a good sense of what the overall trends look like. And you can see on this chart, the effects of the great financial crisis, delinquencies hit right at 10%. And it was a little bit, of course, delayed from the time the financial crisis hit. So the GFC happened in 2008, give or take late 2008. Delinquencies in CMBS and the conduit sector didn't really spike up until around 2010. Much of this is because leases are long. There was also the sense that the great financial crisis would be contained in the housing market without that much bleed into the commercial market. But overall, roughly 18 months, 2 years later, delinquency spiked up and we hit 10%. This time around was markedly different. So I work at Wells Fargo. In the second week of March, I got told to start working from home on a permanent basis. That month, that very month, delinquency spiked in conduit. Bam. So there's no delay. There's no 18 months later, maybe we might have an issue or two. This one has been immediately impactful to what's going on in commercial real estate. So we didn't quite, we did. We breached that high by a smidge. But then, interestingly enough, after this initial impact, delinquencies have actually started to tick back down. So we're still high, 9.8%. It's not great by any stretch of the imagination, but it has come off a little bit from that 10%. So this poses some interesting questions about why this might be happening. And it also poses some interesting questions about what delinquencies will end up looking like once they start affecting the office market. Because to date, the other slide on this chart shows how the delinquencies have affected the various property types. Of course, hotels got smacked first and foremost, they always do. But then on top of that, the retail sector got smacked really, really hard. The office sector, you'll see delinquencies are under 2% still. The question in everybody's mind is that the next shoe to drop?
So, Lee, I also notice on this chart that multifamily ticks a little bit above office, and there's been a lot of concern about rental payments, particularly in the older class B and B minus property assets, where it seems that rental payments are much more current, amongst institutional quality assets, the kinds that are typically charted by the National Multi-Housing Council. Can you talk a little bit about multifamily as well?
Sure. So the multifamily sector is, it's difficult to decipher exactly what's going on. There's a lot of competing trends in here. So for one thing, I mentioned that conduit delinquencies are the ones that we turn to get an overall sense of how the market is doing. That said, agency CMBS, Fannie and Freddie are the big multifamily lenders. So the properties that make it into conduit on the multifamily side, those tend to be less pristine collateral. Typically, borrowers will go to conduit if they cannot get a loan from Fannie or Freddie at the terms that they're looking for. So there's already a bit of a negative selection bias on the stuff that comes into conduit. So even still, at 3%, this is not a whole lot given everything that's happened. On the agency CMBS side, the delinquency rates are actually much lower. So they haven't even breached 1%. We're measuring them in basis points still. Mm-hmm. Much of this is because of a few competing factors that are going on. For one, certainly the CARES Act did quite a bit to bolster tenants' ability to continue to pay rent. The extended unemployment benefits were certainly a big help. Those are just now starting to fade away. On top of that, there have been eviction moratoria. Even within the CARES Act on the agency CMBS side, there were restrictions on, or there was a program set up to allow borrowers to ask for forbearance in exchange for an eviction moratorium. So there have been a lot of policy moves that have helped to bolster up the multifamily sector. Certainly the CARES Act is a big part from the fiscal part of it, but also the CDC's action about no evictions has also helped. I think it is an outstanding question about what happens next. I think, speaking from my own personal experience, I think that while many of these surveys coming from, say, the NMHC are certainly important, the National Multifamily Housing Council showing that, I mean, overall tenants are paying, roughly 95% of tenants are actually paying rent. I think for me, the more interesting question will end up being what happens to demand for multifamily properties over the course of the next year. So thinking about renters and kind of splitting them into two categories. On one hand, there's the renters by choice. I fall in that category. I'm a renter by choice. My utility function has changed, putting it in economic terms. Because of COVID and the work from home situation, a little 750 square foot apartment just flat out does not cut it. And so the question comes up for those of us that are renters by choice, do we actually continue to choose to rent given the current economic situation and with our leases starting to roll? So my lease doesn't roll till April. I know plenty of people's leases have already rolled. I would expect to see overall demand for apartments for those of us who choose to rent to actually start to die down as we choose to instead look to multifamily, to single family rental, to looking to single family buying, to single family rental, to other forms of housing that might be a better fit.
Yeah, and so the the connection between fundamental markets and the securities markets remains an important link, and we'll try and get to that as we go along. But where the rubber meets the road in CMBS is what are the mechanisms that the special services are using to try and cope with this spike, particularly in the more stressed areas of CMBS. Can you talk about what you're observing in the special servicer universe?
So the special servicers got slammed, of course. You can see also on this chart how the special servicing percentage rose. This time around, the special servicers came armed with a bag of tricks. Just like the Fed has its bag of tricks that it was quick to pull out, things that it learned from the great financial crisis, special servicers have done the same thing. So after the great financial crisis, it took quite a while before modifications became the norm. We even needed to change REMIC laws to allow for modifications to happen within the CMBS sector. This time around, all of these things came into place near immediately. The servicers have, and I don't want to give a blanket thumbs up, 2 thumbs up to the servicing community, but by and large, it has done a very good job of managing the flow and also of separating out borrowers that it can help, borrowers that it should help, versus borrowers that may be looking for a free ride or some sort of relief that they don't necessarily need. When we look at what's going on, the modification percentage, the percent that is in forbearance, has gone up by quite a bit. We're still at that phase where it's too early to say how this will all end up playing out. Your typical forbearance agreement, a borrower doesn't pay for 3 months, and then over the course of the next 12 months, the borrower comes whole on that loan. So there are certainly questions about whether or not those borrowers can actually perform after this initial forbearance period, especially given that it's getting to be winter, COVID rates are ticking, we're not out of this. There's still a lot to go. The other thing to remember with special servicing is that it's slow. I think people tend to always forget this. Everything with servicing is slow. It takes 3 months to get an appraisal. It takes 3 months to get in touch with the servicer. It takes a long time. And in fact, we are still in the early innings of this.
So, lessons learned from the last time around. Certainly the universe of special services has changed from 2009 and 2010. Thank God that we remain teachable and educable. This is one of the strengths of the real estate industry, and one of the things that we've gotten stronger with actually over time hasn't it, that we get more useful information, a greater quantity of it, and more actionable information. So last time around, there was a real collapse in new issuance, and that collapse took years and years not to return to a prior peak, because I don't believe it ever did, We were up around $250 billion of issuance at peak before the GFC, and got back, to maybe 60% of that this time around. What are you seeing in terms of the potential for new issuance and the duration of this trough in the market?
This one has been interesting in that, again, lessons learned. The Fed was just very, very quick to step in. And so because the Fed moved as rapidly as it did to set up things like TALF for CMBS, last time around took years to come into place. This time it took days to come into place. Because of all of these things that have happened, the new issuance machine in CMBS actually never stalled out. We had a month where securitization was not as active as it could have been otherwise, but really that's been about it. So surely this year we'll see lower issuance come out overall, but the machine is still functioning. The banks have not let go of their entire securitization departments. I still have a job this time, so that's a nice change. So I think overall, the machine is still cranking out deals. Originators are still making loans. The one thing though, is that the mix of loans that originators make has changed. So on this chart at the top, this shows the breakdown of property type within securitizations, Q1, Q2, and Q3. So Q1 2020 looks exactly like 2019 and 2018 and prior years have done, perhaps with a little change in retail, but more or less intact, where much of it was office, a good chunk of retail, lodging was not a small component of this at all. In Q2, the thing that we saw to happen pretty much immediately is that the lodging disappeared. There's no lodging. So trying to get a loan on a hotel right now is an incredibly difficult proposition, or at least a conduit loan. The other thing that we saw is a very substantial reduction in the amount of retail that got done. And of course, when something goes down, something else has to come back up. So what we saw instead, a decent amount of multifamily actually made it into the conduit space, primarily because right after all of this took place, the agencies initially pulled back. They're back now, and so now we're seeing less multifamily in the third quarter, but in the second quarter, both Fannie and Freddie pull back a little bit. The other thing that we have seen is office. And it makes sense for why this is. The lease terms are longer. People may feel more comfortable with an office building because of the longer lease terms. And this idea that eventually we'll get our feet up underneath us before that lease actually rolls.
So we do have a pipeline coming through. And you mentioned TALF. Of course, the L in TALF is liquidity facility, right? And
yes,
that needed to be propped up in monetary policy, and now it seems like markets are managing without that kind of intervention thus far. We don't know what 2021 brings for sure. So good news on the pipeline, but what's happening with pricing?
Well, pricing, kind of less good, although pricing also is an indicator that tends to lag. So what we have seen so far is not necessarily that much of a change in pricing. So this slide is using data coming out of Real Capital Analytics. So they track transaction volumes, and then they base a price index off of these actual transactions. So there are other indices out there that rely on appraised values or opinions of, or owner opinions of value. This one is a true transaction record. There's pros and cons with this. Whenever we have a stoppage in transactions, then we also have pretty much a stoppage in price movement. And that's exactly where we are right now. So if we look at this, what we see is that year-over-year declines in transaction volume are huge. Essentially, nothing is changing hands. And so because nothing is changing hands, likewise, we don't have a good view on what values are doing. So it does feel like the things that are trading hands, they are coming at a little bit of a discount, especially in the retail sector, no surprise. That said, because of the requirements for loans that hit special servicing in CMBS, an appraisal is ordered. So after a loan hits 60-day delinquent, that is a trigger for ordering an appraisal. So we are starting to see appraisal values come in. You know, at this point, I feel like appraisals, it's not completely a guess, at least it's an educated guess, but without transaction volume to benchmark that off of, it is a little bit of a difficult thing to come up with what a clearing value for property may be. That said, it looks like what's coming in across the retail and the hotel assets, values are down somewhere between 25 and 30%.
Is that because it's the most distressed properties that are transaction, the ones in which sellers are particularly motivated?
I think that everybody's making a guess, to be perfectly frank.
Mm-hmm.
There's not a lot of anything that's transacting at this point. We haven't yet hit that point where these distressed properties are actually getting sold. So looking at the values that come in, it feels very much to me like what appraisers are doing is trying to figure out a stabilized cash flow and then applying some sort of distress cap rate and calling it a day. So, you know, ballparking it, it looks like the cap rate that appraisers are using is somewhere between 9 and 9.5%. Essentially, if you base that off of 2019 ending cash flow, that's essentially what you get. I think it's probably going to take another 6 months or so before we end up seeing enough of these distressed transactions coming through that we get a good sense.
Oh, okay, and when that happened last time, what happened was a real bifurcation of the debate between those who said it's in the industry's interest to be extremely disciplined and to market very aggressively, versus those who said don't make longer range decisions on the recapture of value based upon temporary distress, but look to the ability of values to sustain themselves and rebound, the so-called pretend and extend strategy. Do you see that debate shaping up? Will there be a push to market in CMBS world? And if so, does that exacerbate the problem?
I think the debate needs to be separated between what happens on the loan side and what happens on the bond side.
Mm-hmm.
The loan side, looking at what special servicers are doing and what appraisals are doing, it already appears like kick the can is the right approach. I mean, let's be honest, if a hotel has zero cash flow, it's really hard to value it at anything, right? And so even still, these appraisals that are coming in at 25% off indicate that there is this idea that things will end up stabilizing over time. So I think on the property side, on the appraisal side, and on the loan side, there is certainly this sense that we're better off just kind of giving these borrowers a bit of a buy. That has ramifications for the CMBS deals as well, because the servicers will advance on loans up to a haircut on the appraised amount. So if an appraiser says the property value is off 30%, you compare that to the outstanding loan balance, and that sets the amount that the servicers will advance on it. That ends up feeding through to what bond prices are, because at the end of the day, investors value bonds based off of expected cash flows on that bond. And so as long as those cash flows still look okay, it holds up bond prices pretty well. You know, there is this split though, because once we start looking at CMBS, we're much more influenced by what the Fed does, what risk appetite does, what the broader economy does, how investors seek out yield, et cetera, et cetera. I don't know that it's an extend and pretend game on the bond side, more that because of how low interest rates are and because of the Fed's actions, investors are being forced to take yield wherever they think they can do it safely. And so this kind of by its very nature leads to higher prices than might otherwise have you'd expect.
And is that influenced by the volume of capital that's available in the overall debt markets, which I think is still fairly robust?
Yes, yes, it's very robust. It's very robust. To kind of put this in perspective, you know, I have colleagues that study the residential market. The Fed is buying up roughly a third of all of the resi production right now, a third. So in terms of propping up the market, the Fed is actually buying more resi paper than what would otherwise have necessarily been absorbed by the market. And so the market is by that, just that right there, needing to stretch away from what it's used to buying into more key assets. So for me personally, I have been amazed at how aggressive the Fed has been, and really how much, I hate to use the word control, but it is what it is, how much control the Fed has over pricing spreads. Yeah.
What are the CMBS bonds, particularly in the mid-range, not at the AAA level, but also not at the non-investment grade? What are they principally competing with in terms of yield at this point?
Usually we benchmark CMBS spreads to corporates. So right now at the top of the capital stack, spreads on CMBS are 90 basis points over swaps. So call that what? Not quite 2% yield. On the corporate side, you can get a little bit better than that. If you go further down the capital stack, even at the BBB level, you can pick up maybe 5% of yield if you pick the right asset. So again, you comp it to high yield corporates, where again, in the corporate market, you can do a little bit better. But again, you're not, it's hard to think that where we are in the credit cycle, buying low investment grade debt for a 5% yield is a good investment, but it is what it is.
Yeah. You know, you earlier alluded to the connection between the securities real estate market and the fundamental real estate market. So from the perspective of someone who is trying to get a basic commercial mortgage loan at this point, which may ultimately find its way into the CMBS market, what do you monitor? You know, what the underwriting standards of the originating lenders are, and what are you seeing? How if someone is a borrower coming in looking for credit, what are they facing at this point?
We do track origination trends. So this slide, and I apologize, I know it's going to be small to read for people looking at this from home. I think the slides will be available. If you ask me, I can send you the slides. So essentially, this shows underwriting metrics for both agency CMBS and non-agency CMBS, again, that quarter. So first quarter is a lot like what 2019 looked at. Q2 shows massive disruption. And Q3 is kind of what we're seeing now. Here we are in Q4, but there hasn't been enough really in Q4 to talk about it one way or the other. So overall, I think the thing that surprises me the most about this chart is high level, the metrics really haven't changed that much. So going in, if you're looking for a non-agency, a conduit CMBS loan, your loan to value needs to be south of 60% for sure. It's going to vary by property type, of course. It's going to vary by other characteristics. But right now we're coming in and call it 57%. So, I mean, it's not that different. At the beginning of the year it was 56%. Now it's 57%. We're pretty unchanged. Because the coupon has dropped quite a bit, what we're ending up seeing is that the debt service requirements are still well north of 2 times. We are, however, seeing a few tweaks to the way a loan ends up looking. We're seeing more amortization come back, and we're also seeing more requirements for reserves. So while your high-level metrics are more or less flat, very, very often the things we see is a new COVID reserve. So this can be a tenant improvement, this can be a debt service improvement or a debt service coverage reserve. This can be something that essentially protects the lender a little bit more in case things go badly south.
You know, are you seeing any changes in loan terms reflecting, by terms I mean the duration of the loan, no. Reflecting the after effects of the pandemic?
No. CMBS is a remarkably stable structure. Loans that go into CMBS deals are by and large 10 years. There are a few 7-year loans, there are a few 5-year loans, but because the investor base looks to CMBS for duration, and because the investor base likes the 10-year bond, the loans that go into CMBS are typically 10-year loans. Before the crisis, CRE CLOs had gotten to be quite popular. CRE CLOs offer more flexible terms. You're typically floating rate. They're typically for shorter duration. That market hasn't yet gotten its feet up underneath it. we're hearing rumblings that it's starting, that this market is coming back, but so far it has been pretty subdued.
You know, and of course the fact that the 10-year Treasury, which is benchmark for that, is south of 1%, certainly gives some spread. But you know, as you perceive things, are investor, that is, say, debt investors, on the originator side, as well as on the securitized side, are they being paid for the risk that they're taking, given the level of risk premium that's measured above the Treasury?
Yeah, I think that's the $1 million question, right?
Yeah.
Are you getting paid for the risk that you're taking? So I've been at this game a long time. I do not know if I can ever remember a single investor saying to me, you know what, I feel like I got paid to take that risk. I think always there is this sense that returns and risk are out of line. Thinking about this kind of on a more macro level, from an investor's perspective, whether or not on the originator side or a bond investor, they have money that they have to put to work. Their job is to get as much yield as they can in the safest way that they can. And that's kind of it, full stop. So looking out there right now, given where treasuries are, given where risk to the overall system is, CMBS does offer a compelling alternative. It is certainly trading much wider than, say, ABS bonds. It is trading, you know, in terms of corporates, there's reasons to pick CMBS corporates or certain corporates. You know, so I think it's a little bit of a loaded question. There are certainly some times in my life when I've been happy to be sitting in a researcher seat instead of an investor seat. Right now is certainly one of those times.
Yeah, you know, it's funny. I maintain a long time series on spreads, and you know, just to put some metrics on it, I use the 65th percentile of spreads as if you're above that, you're probably being paid amply for the risk that you're taking. If you're below the 35th percentile, you're probably not being paid sufficiently. The interesting thing is that the area between those two lines is very narrow, and it's so narrow that the market seems not to remain there very long, which from a theoretical standpoint is a bit counterintuitive, because that should be equilibrium, right? That should be where equilibrium is. But this market seeks equilibrium, but it never rests there. It blows through it, and you know, I think at this point that's a metric to watch, and you know, it's something I have in mind when I ask the question: are we being paid sufficiently for the risks that we're taking?
And so what's your take on it? Are we getting paid sufficiently?
You know, the problem again is that there's really not enough evidence on new originations of standard debt. And so we're caught in the same dilemma as financial analysts, as appraisers are in the market. If transaction volume is insufficient, you don't have the kind of sample size that gives you comfort that you've got a statistically significant element. So that's confusion, right? That's uncertainty, and uncertainty itself is a risk element in the market. And you know, I don't want to step into your role as the expert on this, but my observation is that that period of uncertainty extends clearly into and through 2021, and so we're going to see risk, the need for risk premiums to pay for uncertainty expand outward. Does that make sense?
It makes a lot of sense. It also brings up something that I've been thinking about, but I don't have a good way to measure. Many of the changes that we're seeing because of COVID should lead to the need for higher risk premium in the form of cap rates. So I think going into this, there's certainly the sense that If a retailer told you they were going to pay you rent, then they were on the hook for paying you that rent until bankruptcy was declared, right? And what we have seen over the course of COVID is that that may or may not be true. You may need to take that retailer to court and sue them to get your rent payment. And I think that just leaves one additional uncertainty in the market's mind about what cash flows actually end up looking like. And I wonder, again, on the multifamily side, with many of the measures that have been taken, eviction foreclosure or eviction moratoriums, et cetera, whether essentially commercial real estate investors go forward will require a little bit more of a risk premium because the certainty of cash flows has been diminished.
You know, so I'm looking and I'm seeing that our discussion is having its intended effect. And that we're starting to see questions pop up in the Q&A section. Before we get to them, because I think this is an important framing issue, what are your perspectives on the impact of public policy, both monetary and fiscal, is likely to happen on real estate and real estate lending in the very short term? Because I think long term, it really becomes a guess. But yeah, what are your perspectives on monetary and fiscal policy?
So here's a list. It's a little bit shocking how many things we have already had to come through the system: the CARES Act, the this program, all of the different things from the Fed. I think the importance of these programs cannot be overstated. The Fed has really done an amazing job at keeping the markets functioning very efficiently, very smoothly. And I expect, given even Powell's statements yesterday, I expect a continuation of just that. That coming out of the Fed will do everything in its ability to keep the markets functioning smoothly. You know, how that ends up playing out, you know, we was focused on CMBS. Obviously, banks are huge owners of commercial real estate. Many of the loans at banks, especially smaller banks, may end up going bad. You know, there's a lot of noise there. But I fully expect to see the Fed do whatever they need to do to maintain the stability of the overall system. So I think that really is a boon for all of us and for the investment community, that this whole fear of systemic risk is somewhat muted. On the stimulus, you know, again, our conversation is very timely, seeing as, you know, Congress seemed to have been like, you know, they weren't going to agree on a stimulus package anyways, it didn't seem like, and then the president just killed it, but now he's talking about something else that, you know, maybe we'll bail out airlines or something. I think Chairman Powell stated it best, that fiscal and monetary policy do need to work hand in hand, that we need the both of them to really shore up the economy. In a certain sense, what the Fed is able to do is to bail out the markets. What the fiscal policy is able to do is to bail out the people. And when we think about commercial real estate, you kind of need to have both. You need people in the offices, you need people shopping, you need people that are able to pay rent. And at the same time, borrowers need to be able to finance their loans. The capital markets also need to be functioning very well.
Yeah, yeah. One of the images that I used in speaking after the initial stimulus bill was passed in 2010, and then an add-on never came out of the fiscal side, was the image of a rowboat with the Fed on one oar and the congressional and executive on the other oar. And if you have one rower, the Fed, pulling hard, and the other oar out of the water, the rowboat just goes in circles. And you know, that to me is the risk that we have at the present time. And you know, until we get coordination, you know, I fear that we've got an extended period in the economy in which we are not going back to what our previous GDP was, but an even longer period before we get back to potential GDP. You know, and I actually place that in the second half of this decade, which is not a very optimistic point of view. with that bit of pessimism, I think I'm going to turn the reins over to Neil, who has been monitoring Q&A and the chat area. So Neil, do you want to push us along a little bit with Q&A?
Yes, be glad to. And I have a number of questions from our participants. One is, can you just repeat again, I think you caught everybody's attention, Lee, when you said a 9 to a 9.5 cap rate. Can you just repeat for what property type and what location you were talking about?
I wish I had more, better data. So across my data set, I have 166 values. That's it. Most of these are hotel and retail. So when we talk about cap rates, please keep two things in mind. One, my data set is small. And once you also factor in the property types that we're talking about, it is hotel and retail. So when I looked out past that, like I have like 4 or 5 office transactions, it's not enough to come up with anything meaningful. The 9.5 looked like it was about right based off of 2019 last cash flows or full year cash flows.
Mm-hmm.
It was closer to 9.5 for retail and closer to 9 for hotel, which might be a little bit counterintuitive. But again, small data set. But right now with so few data points, I can't slice and dice it by property class, by location, because then I simply get too granular. I think so we get CMBS data monthly. We should start getting new data in I don't know, 2 weeks or so. I feel like probably between now and year end, we will have a much richer data set so we can do a little bit more of a finer slice and dice on.
So Lee, we analysts, look at data all the time. What should more general participants in the real estate market, those who are representing users of space, those that are representing owners of space, what can they monitor on a near real-time basis in terms of data that is generally available and that you think is meaningful?
My preference for easy to access, relatively clear data is the things that come out of CBRE. So CBRE's property division is quite prolific, and they produce things very regularly that are both insightful and have enough color that you can glean some information. There's also local sources that do a very good job. For instance, if you have something, Manhattan multifamily, you can Google Manhattan multifamily cap rates and you'll have 500 articles about what they are. But I think CBRE does a little bit better or more thorough of a job on looking at different markets. And it's also freely available, which helps. They also have a subscription, but their free stuff is good.
That's good. Neil?
We have a question for a deeper dive on the debt service coverage ratio. Do you have access to that with respect to underwriting criteria by property type?
I do, yes. So I can, for the questioner, if you contact me separately, I can provide you with more detailed data. Overall, it tends to be closer to a 3 times for the property types that are most volatile. It tends to be closer to a 2 times for those that are not. So we're not seeing any hotels, we're seeing very little retail at this point, but it certainly expect closer to a 3 times if there's anything with any hair on it.
That's substantially higher than in the past, is it not?
Oh yes, it definitely is.
Yeah.
It definitely is. Much of that is driven both by a combination of really low interest rates. So your debt service by itself is not real large. And the other thing that is a constraining factor on that is the amount of IO that's available.
Right. Got it. Next question, a little more of a deeper dive on forbearance. Here are the series of questions. What % of loans roughly as they transfer to special, will there be normal fees when they transfer back? Do documents allow for it? Are investors in an uproar over it? And how are servicers feeling about advancing loans that are in forbearance? And are investors nervous about that?
Oh my!
That was a machine gun question.
Sounds
Okay.
like someone who's got some worries keeping them up at night.
I think
Yep.
so. I think so. So when we look at, it's a little bit of a difficult question to answer, to be perfectly frank. So for loans that have gone into special servicing, the go-to solution that the special servicers have allowed is more of a consent rather than a true forbearance agreement. So a consent essentially allows redirection of reserves to pay debt service. So this is extremely common with the hotel properties that have seasonality reserves or any kind of, PIP plan or anything along those lines. Essentially, what the agreement allows is for the borrower to tap those funds that have already been held back to now pay debt service. So yeah, I would ballpark it is well over half of the things that have come through that have been any sort of change, any sort of allowance to the borrower have fallen more into the consent category than they have in the true forbearance category. The question with that, of course, is what happens when the reserves run out? Mm-hmm. So, every loan's different, all this sort of stuff, but it looked like when we ran the numbers, it looked like on average, your typical loan could cover debt service for a period of about 6 months, given the reserves that it had as of end of year. So the question, of course, comes: what happens when the reserves run out? We don't know. We're now is kind of when the rubber hits the road. In terms of actual forbearance agreements, much of what we have seen is okay. So this is October. My borrower is coming and saying, I need forbearance, and it is October. My borrower is now 90 days delinquent. So this is the forbearance agreement that I will give to the borrower. It's 3 months. So I will mark your loan as current. Now you have the next year to make up those 3 payments you missed. So is that real forbearance? I don't really know. But it is certainly forbearance light. The CMBS side, it has been much more generous. The FHFA has outlined specifically how forbearance is supposed to be conducted. It goes for a period of 3 months or 6 months. I mean, it's very streamlined on the agency side. On the non-agency side, it is really pretty limited. Because of that, because of the usage of consents, and because forbearance has been pretty limited, the master servicers haven't really gotten up in arms about advancing on it, because at this point, honestly, it hasn't been that much.
So where ripple effects start to show up is where those forbearances begin to erode the payment in the lower end of the CMBS tranche stack, and you begin to see compromise in the investment grade area. From what you're saying, it sounds like that's not something that the market is likely to see as a perceived ripple effect until the spring sometime, but that the performance of the triple B and below areas is really something to watch in the first quarter. Is that fair?
Right. Yeah, I think that's right. I think that's right. Hugh, perhaps we should do this again in 6 months and have a postmortem on everything that's already happened. But
from your lips to Neil's ear.
Yeah. Yeah. Well, speaking of below investment grade, there are some questions on that front. First of all, obviously, below investment grade is traded privately, not publicly, so this kind of information is not easily accessible. But do you have any idea, as B-piece buyers right now are pricing what they buy? Do you have any idea what kind of yield they think they're earning, what kind of IRR they think they're achieving when they make these purchases?
Yeah, I haven't asked. I should ask. That's a very good question. My guess is, though, given where new issue deals are trading and where new issue has priced, that it isn't exorbitant. Would ballpark it in the low double digits just based off of where the investment grade stuff is trading. And the world is yield starved. I mean, I think that is that at the end of the day, that's it.
Yeah. Does the identity of the universe of B-piece buyers, though, make a difference? My recollection is that prior to the global financial crisis, we had a migration from B-piece buyers with deep operational experience in the real estate industry to those who were traders of paper. And the traders of paper largely got washed out in the crisis. So today's B-piece buyers, very savvy real estate operators.
So risk retention changed the equation.
Yes.
So in late 2016, risk retention came into force, which said the bottom 5% or some 5% of the CMBS security needed to be held by either an originator or an originator delegate. In this case, the originator delegate would be the B-piece buyer. So that has done much to keep the B-pieces in the hands of special servicing arms and other real estate experts. Unlike before the great financial crisis, the trading of that paper is very, very thin. So essentially, investors understand that once you take that risk, it's your risk. So I don't want to say universally it's held in strong hands, but it is held in hands of real estate experts by and large.
So an issue where the learning of the last crisis translated into regulations that have actually set some useful guardrails for us.
Yeah, I think so. I think this is probably not the right crisis to test whether or not risk retention did its job. But you can certainly see a decline in metrics like LTV once risk retention came. Whether that'll end up being sufficient to do its job in protecting us this time around, the jury's still obviously out. But it did at least set guardrails in place.
Yeah.
Is there any data on how much of a hit those that retain the risk, those issuers have incurred in this crisis, or was it mostly sold to B-piece buyers and we just don't know?
So for CMBS, there's three ways you can hold the risk retention. You can hold the vertical slice going down, you can hold the horizontal slice on the bottom, or you can hold this L shape. For the vertical piece that goes up and down, we know exactly who holds it. That's not a surprise, and it's very easy to calculate how much of a hit they've taken off of this. With the vertical piece that goes up and down, though, keep in mind that the pieces on the bottom count for a very, very small portion of the 5%. So even if they lost half of the value of the very, very bottom 1%, it's still not a whole lot. It's not meaningful. The ones where it makes the most difference are either one of the two forms of the horizontal risk retention. So right now, it looks like there are a handful of deals out there where interest shortfalls have stopped to the lowest classes. I think, again, we're probably a little bit too early. So the deal with CMBS and servicing and owning the B-piece has always been that theoretically there's this trade-off where if the economy does well, you get paid interest on your holdings down on the bottom of the capital stack. If the economy does poorly, you get the special servicing stream. So part of where this fell apart last time around during the great financial crisis is that, back to the whole liquidity discussion, the bonds at the bottom of the capital stack, the pricing on them was horrific even before loans started to default. It took so much time between the great financial crisis and actual defaults within CMBS. This time, because the two have been instantaneous, the special servicers have actually gotten quite a good chunk of special servicing fees coming in the door because of how much is already transferred.
So Neil, I think we're clocking out a little bit in terms of time. Do we want to wrap up and possibly turn it over to Bob for a second?
Yeah, let's wrap up. I again thank all the participants for joining us today, and I'm going to turn the reins over to Bob Morgenstern from the Fordham Real Estate Institute.
Thank you, Lee, Hugh, and Neil, for a very informative discussion. I have no doubt that our students, faculty, and industry attendees greatly appreciated this event. So, on behalf of the Fordham Real Estate Institute, I would like to thank you all for attending today's event, co-hosted by the New York Metro chapter of the Councils of Real Estate and the Columbia University Graduate Program in Real Estate Development. I hope that you keep Fordham on your radar for future events, as we expect to have new events beginning in November. So stay well and have a great day.
That's good. And let me, at the end, give my personal thanks to Lee for taking part in this. Lee, it was my great good fortune to have a chance to see you and to meet you virtually at the UNC Keenan School event back in the spring. And I look forward to maybe 6 months from now revisiting this under the university aegis. Thanks so much.
All right, thank you so much. I appreciate the invitation. Thank you. Thank you.
Thank you, everyone.
Okay.